financial market has a language of its own, and often you come across different words or phrases that you have absolutely no idea what they mean or where they got their names from. Here's a few of them. Bears and bulls. Bears and bulls are used to describe a certain market condition or refer to individuals who are trading the market. When you say a bear market, you basically express a pessimistic point of view, and that means a market in which prices are going down. And a bull market refers to an increase in prices that represents an optimistic sentiment. Now you can also say, I'm bearish on this specific currency, which means I think its value is going to decrease, or I'm bullish on the market as a whole, and that means you forecast a rise in prices. There's a few explanations on why we use these terms, and for me, the easiest to remember is that they derive from the way these two animals used to attack their opponents. When fighting, a bull would throw its horns up, a metaphor for an uptrend, and a bear would swipe down with its paws, which is similar to a downtrend movement. Now, staying in the animal zone, we also have the terms dovish and hawkish. In general, hawkish relates to an aggressive stance that a central bank or other policymaker is taking against inflation by keeping interest rates high, and thus the inflation low. A dovish policy is a more peaceful one and is looking to lower the interest rate in order to encourage growth within the economy. Now, you've probably already heard the expression safe haven. This term is used in times of financial turbulences and high volatility, when traders are in search for an anchor, a strong enough stock or currency. In the forex market, the Swiss franc is often considered to be a safe haven currency. And when the forex market is too volatile, traders look for another investment, like gold. Now, I mentioned the word volatility. What it means is the price fluctuation over time, and the measure of this fluctuation compared to what is the norm. It is actually a way of defining an asset's propensity to gain or lose value. If a certain position is considered highly volatile, it will probably experience dramatic changes in price, whereas a position with low volatility will act in a more stable way. Naturally, the more volatile an asset, the riskier it is. But volatility is not a bad thing. One can take advantage of it in order to gain from the wide market moves. Just remember to be very careful because changes can occur.